Big changes coming to the price of silver and the price of gold. And the price of silver and gold have been erratic lately, at least consistently erratic, with gold hanging in there around $1,980 per ounce and silver hanging tough at $25 per ounce. Now, we have big news this week from the Fed. We also have big employment numbers, and they will have a massive impact on the price of gold. We know the price of gold, it should at least be $150 higher right now. Silver, it should be at $30 per ounce. But if the Fed surprises us with a 0.5 percentage point rate increase, that could be devastating for the price of silver and gold. We're going to talk about the likelihood of that and the likelihood of what everybody's expecting, 0.25%. But what about the blue sky scenario when the Fed has to pause? The Fed's probably going to raise rates. They have to. They've telegraphed it. But are they really fighting inflation? I want you to think about it like this. They're like a firefighter who's squirting the hose onto the fire, while at the same time, on the other side, they're feeding in more fuel to fuel the fire. And that fuel that they're feeding in is the continued printing, continued creation of new currency out of thin air. They have to do this to keep the banking sector in particular right now alive, because we have big problems in the banking sector. Yeah, sure, we're going to raise rates. But at the same time, that's causing big issues in the banking sector. The second and third largest banks in the history of the United States have failed. We have European banks having major problems. Remember Credit Suisse? This isn't even just a problem in the United States. Trust me, Europe is even worse off. But the Fed will most likely raise rates. But it's smoke and mirrors, guys, because like I said, while they're fighting the fire on one side, they're feeding more fuel in on the other side, and that will only serve to feed inflation and make the value of the US dollar go down. And what does that mean for precious metals prices? It's going to take a while. You and I, we're a little ahead of the curve. We don't mean that in an arrogant way. We've just spent the time, spent the mental energy to understand what's going on. When the herd, when the rest of the people, when they wake up, right, they're going to want to come join us on the silver and gold boat, right? We're in there now with the safety of gold and silver. There's only a few seats left on the boat. We know that. There's only so much silver, so much gold in the world. And when that flood of people comes to join us, that's going to mean significantly higher prices for silver and gold. So we get all worried about what the Fed's going to do and what the Fed's going to say. And we're going to talk about that next. We got to remember, no matter what happens, you and me, we're in good shape. First Mining Gold is a development company advancing two of the largest gold projects in Canada. Springpole in Ontario and Duparquet, located in Quebec, each already has 5 million ounces of gold reserves, but exploration initiatives are underway at both projects to find even more gold. First Mining is well-financed, has zero debt, and owns an interest in 4 additional Canadian gold development projects. And we have it on good word from Nick Timiraos. He's the Fed whisperer from the Wall Street Journal. He said he thinks the Fed's going to raise rates, and somehow Nick is usually right. But what really matters is the wording. The whole market could be pegged and hinged on one word coming from Jerome Powell that either indicates further hawkishness or further dovishness. But again, don't forget, guys, right? While they're fighting inflation on one side, they're also feeding into it through the back door. So it's really not going to matter. It will matter short term. Yeah, we'll have some short term pain or gain, but I'm not expecting to see the Fed come out with any dovish language. And I'm especially now not as expectant of the Fed doing a pause. It could happen. Trust me, I'm wrong all the time. and I hope I am, but I want to reiterate to you that no matter what they do, the facts, the big picture facts remain in place, that the value of the fiat currencies, not just the US dollar, but all of them around the world, continues to erode. And there's nothing to worry about in the banking sector, right? We've only had 3 bank failures since March, the second and third largest banks in United States history to fail, but there's nothing to look at there, nothing to worry about, because Jamie Dimon tells us, although he was worried about the banking sector 6 weeks ago, now suddenly he thinks we can be completely resting at ease in the solidity and the strength of the U.S. banking system. I don't know that I agree with that. We could be dead wrong, right? But when we look at the investments that the banks have made in U.S. treasuries and mortgage-backed securities, and couple that with loans they have outstanding on commercial real estate, I don't think it's doing really well right now. And what about all those auto loans they have outstanding that people can't afford to pay? I don't think they're doing too well right now. It makes me feel a little uneasy personally about the stability and what we might have coming down the road. Do you remember 1 year ago today, right now, May 1st, 2022? The Fed funds rate was at 0.5%. It has gone up by a full 4% in just 1 year. The steepest increase in interest rates in history, the fastest and steepest. Not an all-time high, but the fastest and the steepest. That has not bled through into the economy yet. We haven't felt it yet. It has a lagging effect, is what the fancy economists like to say. It's kind of like if you have a bad headache and you take 3 Tylenol, it might take 15 or 20 minutes for it to get into your system and start to have its full effect. We're maybe at minute 3 or 4 right now, when the impact of those interest rate hikes bleeds through to the economy, right? To consumers, to businesses paying much higher rates for everything from mortgages to car loans to credit cards, all of it. What the U.S. government interest expenses on the $30 trillion of outstanding debt, what do you think that's going to do to the economy? So it's going to be real interesting on Wednesday to see how Jerome keeps the 9 balls that he's juggling up in the air. We know the reality, right? They very well may be fighting inflation with a fire hose on one side, but at the same time, feeding the fire through the back door. Because the reality is, they need inflation to make any chance of getting out of this horrific financial situation that our leaders have gotten us into. They need to inflate it away. It's unfortunate, but it's pretty much a mathematical fact. Correct me if I'm wrong. I don't like it, okay? I'm an American. I love my country. You know who else doesn't like it? The founding fathers of our country. Guys like Andrew Jackson, one of our former presidents. Read about him. He doesn't like the situation that we're in either. We know one thing for sure. We can rest assured with silver and gold because they have held their value for thousands of years. Thanks for joining me. Watch another video. Spend a little more time in the basement. Until next time, you be well.